The Federal Reserve obviously deciding to leave interest rates unchanged. That was a move that was very widely expected by the street. But despite the pause, the Fed chair, Jay Powell, struck a very hawkish tone, saying that 2 more hikes are likely to come this year and cuts are a couple of years out. Not going to happen this year, he said, for sure. Joining us right now to break down the Fed's latest move is Roger Ferguson. He is former vice chairman of the Federal Reserve and a CNBC contributor. And Roger, not only Powell's comments yesterday, but the dot plot showed that the Fed thinks that they are going to see 2 more rate hikes this year. The market doesn't seem to be buying that, at least not yet. You saw a temporary drop in futures and lots of other assets as people thought, OK, this is much more hawkish than we thought. But as Powell talked, a lot of that recovered. What do you think? Are they telling the truth?
I think they are telling you the truth. You may recall I was on Monday, said I thought I could see the possibility of 2 more hikes. That seems to be what they think as well. I think the expectation that they have of 2 more hikes is driven by the other statement that Powell made that has been said several times, which is that core inflation is very sticky. And so you saw them mark up their expectations for core inflation. That, I think, is the basis of their expectation for 2 more hikes. They clearly think they have more work to do.
And in terms of what they see with the core inflation, all of them seeing higher rates, I guess the question becomes, how set are they on getting this down to 2% immediately?
They're set to get it down to 2% eventually, and you saw that in their forecast. The 2% is not to be questioned at this stage, and I think you heard Powell refer to the 2% target several times. So he wants to put away the thought that they have a secret desire to keep it at a different number. And I think the other thing they said that's really important is they want to see firm, I think, convincing evidence that inflation is on the path toward that 2%. So I think the market should not get itself in the expectation of, core inflation around 3 is going to be okay. I think the Fed is quite intent on seeing a path towards 2% core inflation over a period of a couple of years, looking at the forecast. So that may be the place where there's a little give. What's the time frame, but not the ultimate goal.
But Roger, if we would just to take a step back and let's say we want to be in a good mood. It's Thursday, U.S. Open starting. It's Father's Day. It's June. The days are long. It's sunny in the morning. We've come a long way from a series of 75 basis point hikes. How many do we have in a row? We had like 3 of them in a row. So now we had a pause, and now we may get 2 more 25. On top of that, core's basically down 50% from the highs. Okay, so can we just agree that we can have a good weekend? I mean, this is 2 more hikes is not 3 more 75 basis point hikes, and 4 or 5% core is not 9 or 10% core. Am I wrong?
No, you're right that there has been great progress, and one might want to celebrate that. And in fact, the reason to take the pause is to say there actually has been great progress. Let's see exactly where we are. But great progress towards the target is not success. And I hate to break it to you, but central banking is not a place to look for happy faces.
Roger, I think the biggest question, though, is the risk of inflation versus the risk of breaking something in the financial markets. I mean, that's where people come down on this. Are these 2 more rate hikes and leaving rates higher for longer going to have a serious impact on the banks? Is it going to impact commercial real estate? How do we see this play out?
Look, I think you put your finger on the major dilemma here. I think Chairman Powell was asked that question yesterday. His response was, we will be as nimble, effectively, we'll be as nimble and careful as we possibly can be. I would have added to that response that they need to develop a different set of tools to deal with bank issues. They've attempted to do that with one of their new facilities. But Becky, you're exactly in the target of the trade-offs that they're making. Having said that, he was quite explicit that the primary mandate of the Fed, as they see it, is inflation. And I think they would like to avoid breaking something. Their forecast is actually for the economy to do reasonably well. And I think they gave a nod to watching credit conditions as well as something that might affect, how fast they move and when that they actually need to execute the plan. So I think they're trying to walk that tightrope. I share with your concern that it may not be doable. And I think they have to develop some new tools to do that. And I think they are going to have to be very, very careful in assessing the state of the credit markets in particular as they move forward with their plan of executing 2 more moves.
Well, look, Powell had this in his favor. He won the idea of buying time, and he got optionality for the July meeting. So if you're looking at things from that perspective, it's certainly a win for him.